Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am here with our host who was missing for a week, Robb Fahrion, CEO and founder of Flying V, Deep Knowledge Investing's digital marketing partner. Robb, we've missed you for the last couple of weeks.
I know, I know. I'm glad to be back in the chair, back in the saddle. Thanks to Enrique. He did an awesome job over the past week. But yeah, you told me don't get Wally pipped. I said, hey, it's okay. I'm a team player if that ends up happening.
Yeah, it was great having Enrique to talk to. Fellow finance guy like myself. He's run hedge funds. He manages a research newsletter now. Really smart stock analyst. It's always fun talking with him and having him on the show. I think it's his second or third time on with us, so that was great as well.
Yeah, it's been great. Gary, for this week, before we jump into our stagflation issue for this week, wanted to tease out a little bit. We got a new research report, new position coming on the DKI blog, I believe Wednesday, if you want to tell everybody a little bit more about that.
Yeah, so the last stock idea Deep Knowledge Investing put out was Shockwave Medical, which we've talked about. We initiated on that in December at $190, and the stock received a takeover offer from Johnson & Johnson at $335. DKI subscribers made more than 70% in under 4 months, so that was terrific. Next idea is in the cybersecurity space. It is a huge end market. We think this is a situation where if things go well, you could make 10 to 15 times your money. That will be up on the Deep Knowledge Investing premium blog on Wednesday morning. And so for those of you who are interested in getting our next idea, and hopefully we'll all make a lot of money together. That's the plan. We'll see what happens. But those of you who are interested, please feel free to go subscribe. Those reports are only available to the premium subscribers, obviously, for helping people make those kinds of returns. We want to get paid ourselves.
Great. Looking forward to that, Gary. And yeah, as mentioned, please head to deepknowledgeinvesting.com where you can grab a subscription. Again, that'll be premium gated content. Don't want to miss that one, though. Moving into this week's 5 things, Gary, we're talking GDP, PCE, government spending, commercial real estate again, and FTC talking non-compete. So let's jump right into it. This is our stagflation issue. Thing number 1, GDP comes in weak.
So first quarter gross domestic product came in at 1.6%. And that's a problem for two reasons. The first is it was way below expectations of 2.2%. A lot of times, Rob, when we talk about these things, we will say, hey, listen, they missed by 0.1%. Nobody's really measuring that closely. I can tell you that when expectations are for 2.2% and you come in at 1.6%, that's bad. That's a huge miss. And there were some economists that had numbers actually that were right around the 3% number. But to make things worse, you need to adjust these numbers. So part of it is we adjust for the change in private inventories. And that's just a fancy way of talking about inventory stocking and destocking. That nets to zero over time. And, whether store owners are adding to their shelves or letting some of their inventory run off, that doesn't really affect your gross domestic product long term. And so when we adjust that, in this case, it was 0.35%, that gets us to about 2% growth. So you think, okay, wait, that sounds pretty good. That's, close to that 2.2% number, but there's a bigger problem. The bigger problem, and this concerned the market, was the price adjustment, which is the way we adjust GDP for inflation, was 3.1%. Now, that's an issue for two reasons. One, it was significantly higher than last quarter. But the other thing is, I believe it's understated. That includes things like assuming, your food prices are up 2%. We've talked about that. It assumes owner's equivalent rent pricing for shelter, for housing, which is not accurate. If you look at, how much the Zillow indexes have gone up or the Case-Shiller index, any real estate index shows increases far above owner's equivalent rent, which is what the government is using for this stuff. And so basically, if that 3.1% price adjustment was off by just 1%. And I think it was off by more than that. But if it were off by just 1%, then what you really end up with is GDP growth of 1%. That is anemic and way below the estimate. This was not a good quarter for economic growth.
Gary, looking at the GDP from last quarter, 328 billion, debt at 500 billion. I mean, just how critical is it in this type of economy where it seems like a lot of misinformation, right? Seems like it's a rocky ship, but just how critical is it to wisely position your portfolio with what's going on currently?
So it's crucial. And the reason is that GDP number, let's say, I'm saying it was somewhere between 0 and 1%, depending on what inflation adjuster you want to use. The government says 2.2%, but let's say their number's right. Let's say the government is right and GDP growth really was 2.2%. The real issue there is we can get a look at how much government spending is distorting the economy. In that quarter, GDP growth, if you believe that 2.2% number, was 328 billion, but increase in federal on-balance sheet debt was about $500 billion. And so that tells you two things. One is that government spending is destroying value. The government overspent by $500 million. They added all of that debt, and we got $328 billion of GDP growth. So the multiplier there is actually a fraction, right? Every dollar of government spending is getting us less than a dollar of value. And that's horrible. The fact that the government is becoming a bigger part of the economy and destroying value it's just not where we want to be. The other thing is, if all of the increase in GDP can be attributed to government spending, and the government spending had a negative impact, think about what that means for the private economy, right? By definition, that means the private economy had a really bad quarter. And so we're at the point now where the government, by excessive spending, or through excessive spending is a better way to say it, is creating the GDP number they want. So they get, positive headline numbers. They're keeping us out of a recession officially. But the private market economy is being pushed out by all of this government spending. The government spending is destroying value. This is not sustainable, and it's not a good place to be.
Great. Gary, moving to thing number 2, we're talking PCE, and the PCE comes in hot: personal consumptions expenditures.
Yeah, so the reason the PCE matters is that's the preferred inflation metric for the Federal Reserve. People most people will look at the CPI, the Consumer Price Index, as the measure of inflation. But the reason the Fed focuses on the PCE is because that's more closely tied to people's actual expenditures, right? How much did people spend? What did they spend on before? How much did they spend? It's a more accurate indicator. In this case, for March, the PCE came in at 2.7%, which was above expectations of 2.6%. But even worse, it was an increase from last month. We're blowing apart the whole disinflation story. And again, disinflation is a change in the rate of change. It's saying we still have inflation, but at a slower rate. The core PCE, and that excludes food and energy because they tend to be volatile, that was up 2.8%, which was also above expectations of 2.7%. And that hasn't been coming down. That line has been really flat. You'll see, Andrew was going to flash the graphic, the chart up on here. And you'll see, I'm just taking a look at it right now. It's that red line on top, and it's just been really flat. It's not coming down. So the other thing that we're looking at here is personal income was up, but spending was up more than both income and inflation. What that means is that people are buying more, paying more, and using more credit, which is something we've been talking about a lot.
Gary, the takeaway here is regarding rate cuts, right? And that it looks like we're going to have reduced rate cuts. Just curious, on the DKI side, right? It seems like you've been so spot on with this. Why do you guys have such a great track record of understanding these rate cuts based on what you're seeing in the market?
I think people have been missing a couple of things. One, there's a lot of wishful thinking. There are a lot of asset gatherers who are people they claim to be money managers, but they're not really. They're just closet indexers. They own the same stocks everybody else does. And they're hoping that if the Federal Reserve were to reduce interest rates, that will reaccelerate the asset bubble that we saw before. And, their stock positions will go up. There won't be real economic growth. We'll just have more inflation and higher stock prices. And, they make a percentage of their assets under management. And so that will grow. So that's part of it. The other thing is people have been misreading the Federal Reserve. If you look at Deep Knowledge Investing's April letter, which came out last week, we actually talked about the fact that the Federal Reserve has been horrible at predicting interest rates, even though they're the ones who control interest rates. If you ask the Federal Reserve, the governors of the Federal Reserve, where interest rates going to be in 6 to 12 months. We tracked this. We tracked it for years. They're never even close, right? I mean, they're wrong by huge margins. But what we've understood is the psychology there. And Chairman Powell, Jerome Powell, is the chairman of the Federal Reserve, does not want to see inflation reaccelerate on his watch. We've talked about the Federal Reserve Chairman Arthur Burns in the 1970s. He let off too early on interest rates, and we got inflation roaring back. And then it took the chairman who succeeded him, Paul Volcker, to raise rates up around 20% to get inflation under control. That caused a massive problem in the economy. But between the two, Powell has been crystal clear, saying that he wants to be the next Volcker. He wants to be the one who saves the economy, not the one who lets up too early. I think the final thing we've looked at that other people haven't is we've been really clear on understanding that massive government overspending is just providing a huge amount of stimulus and inflation, right? The government is printing money, they're adding debt to spend, and they're telling us that these are investments. These are not investments in any way that a normal person would think about investments. We are simply pulling future demand forward. Right. So we're taking the things that we would buy tomorrow and we're saying, let's just buy them today and put it on our credit card. When that happens, you end up with inflation. And so I think we viewed these things differently and more accurately than a lot of other people have. And, the point that I would make right now is our view is that higher for longer, which is something Chairman Powell has been talking about related to interest rates. Not only is that going to apply to interest rates, it's going to apply to inflation. Inflation is starting to pick up again, and the way the government is spending, it's not going to subside unless we have a massive recession, which, again, right now in an election year, the government will spend anything to keep us out of that. Nobody who's an incumbent in Washington wants to face that situation. So be prepared for more inflation. And, here's the thing. That is a challenge for most people, for their households, for their portfolios, for their economic security. This is also the stuff that we've focused on to help our subscribers protect themselves, protect their homes, protect their portfolios, and actually make money over the last 2.5 years in this higher rate, high inflationary environment. We've set up a portfolio designed to outperform and benefit from these things that are horrible for all of us. And so, if this is something that's overwhelming for you or difficult for you, reach out. This is the kind of help that we've been able to provide our subscribers for the last couple of years.
Segueing into thing number 3, I think this is a perfect segue, Gary.
Yeah.
Thing number 3, too much government spending and voting won't fix it. We had DKI board member and economist Michael Shedlock, or Mish, as those most closely acquainted with him know him by.
Yeah, first of all, we're so cool. Even our economists have mononyms, right? There's Cher, Madonna, and Mish.
Yeah, exactly.
But worth pointing out that I have been reading Mish's work, his economics blog, for maybe 15 years, maybe longer. And the reason I read his work is because it's that good. And I was really excited a year ago when he joined the DKI Board of Advisors. I think he's really sharp on economic issues. And again, I'd been reading his work for well over a decade. So his point here, which is very much consistent with mine, is that he thinks the Fed is going to struggle to contain inflation. And the thing that he points out, again, same thing that we have, the government is running a massive deficit. On Mish's numbers, I'm reading this here, 1.1 trillion so far in 2024. CBO projections, which we've criticized roundly in the past, they show expectations that that spending is going to exceed government tax collection for the next 3 decades. So they're not going to let up on spending. And the plan, as they've stated, is to add to the debt every year. And so Mish is making the point that even those projections of increasing spending and increasing debt and increasing deficits every year, even those horrible projections are too optimistic because they don't factor in a recession between now and 2054. So 30 years. So, let me just ask you, if you're listening to this, if you're watching this, do you think the United States is going to go 30 years without a recession? Right. And put it in the comments. I'm interested in your point of view. I don't think there's any chance of that happening. Mish doesn't believe there's any chance of that happening. Let's just be clear. There's no chance that that's going to happen. And so, CBO projections, which are bad, by bad, I mean very negative in terms of our debt and our spending and the implications for future inflation. They're too optimistic. Things are going to be worse than the CBO projections.
So it sounds like, Gary, we're going to get more spending no matter who wins in the November elections. Just seems like continuous spending and spending and spending into oblivion. How does this even get fixed, right? Because the picture we're painting is not only an ugly road, but an extremely long road as well.
Yeah. So I don't think it's going to be fixed. And I feel horrible saying that. Rob, I was born in this country. My parents were, my grandparents were. I grew up as an American and loving being an American. I remember as a kid decorating, I was 6, 7 years old and decorating my bike with red, white, and blue crepe paper and riding it in, my little town's 4th of July parade, growing up in Michigan. And so, it hurts. It's really hard to say we're not going to fix this. One person, I read John Malden's work, and John was on a Twitter space with Michael Guyad recently, and Guyad does phenomenal Twitter spaces. I'm fortunate to say he's had me on a couple of times, but he regularly has on amazing guests. And Michael gave me the opportunity to ask John a question, and what I said to him is, "Hey, John, you think this is going to get fixed? Why?" And he gave me what I thought was a really interesting answer and a smart answer. And Mullen's answer was, because when push comes to shove, Americans will do the right thing. And there's an old saying, and I want to say it's Winston Churchill. I could be wrong. We can always count on the Americans to do the right thing after they've exhausted all other possibilities. And there is some truth to that. Americans tend to be optimistic. We tend not to get, bogged down in the details until it's a real problem. And then as a country, when we focus, we tend to be able to accomplish incredible things. That's Malden's point of view. I hope he's right.
Hmm.
I would love for John Malden to be right and Mish and me to be wrong, and to come on here a few years from now and issue a public apology. I don't think it's going to happen. I would love to be wrong and just say, "Hey, John, you were right. I apologize. We shouldn't doubt you again." Mish's point, and unfortunately I agree with it, is that it's very much an American point of view that, hey, don't like the government, don't like government policies, go vote. And that's a pretty powerful, it's a powerful statement. It's a powerful statement to think that we as Americans could say, "I don't like government policy. I don't like the people we have in place. I don't like what's going on. I'm going to go vote for something different." We as citizens can make changes. And that's a really powerful notion. And it's a wonderful idea. In this case, it won't matter. Whoever is in the White House in January of 2025 has a demonstrated capacity and inclination towards massive overspending. Whether it's Republicans or Democrats who are in control of Congress, guess what? They overspend as well. We have seen in my lifetime every combination of Republican and Democratic control of the White House and Congress and mixed government and unified government. And the only thing that we get is more and more and more spending. There is nobody that we're going to be able to vote for who can credibly win this November that's going to slow down spending. So, John Malden, I respect you. I disagree with you. I desperately hope that I will have the opportunity to apologize to you and admit that you were right. In the meantime, Mish and I both think it's just going to be higher government spending, higher for longer on interest rates, higher for longer on inflation. Again, I feel terrible saying it. I wish this weren't the case, but given that that's the environment, and given that I don't think we can vote our way out of it, the only thing we can do is invest and budget and plan in a way that protects our homes and our portfolios. And that's what I'm focused on. I don't like complaining that it's a good market or a bad market, or complaining that I don't like policy. It's our job to find a way to make money for our subscribers, regardless of conditions, whether I like them or not.
Thing number 4, recent weeks, we've been talking a lot about the commercial real estate space. We're coming back to that again. Thing number 4, mall owners buying failing tenants. Tell us about that, Gary.
We've been featuring problems in commercial real estate, I think, for 2 months now.
Yeah, 2 months.
It is a big problem. Smart people like Enrique Abeda from HX Research, who was here with us last week, has pointed out, and other people have pointed this out too, hey, this won't be as bad as 2008. We don't think it can take down the economy. The banking sector there's less leverage, concentrated exposure here. Those are all valid points. I'm in no way suggesting that we're going to have a commercial real estate disaster next year that will rival the 2008 housing disaster, but it's bad and it's a problem. And this week we're focusing on some insane behavior by mall owners. I also want a hat tip here to Wolf Richter of Wolf Street. His report on this was the first place I saw it. The information's out in public, but I saw it there first, and it's always good to give credit. Hat tip to Wolf for covering this really well. So what he pointed out is that Express Inc., and that is a retail company they own, Express, Up West, and is it Bonobos? I think it's
Yes.
Bonobos.
Yes.
All right. Sorry if I've mispronounced it. But the company is filing for bankruptcy. And after planned closures, there are going to be 435 stores. So there's a group of buyers that are going to buy these 435 stores and the brands out of bankruptcy. Okay, this is normal, right? That's fine. So what's the problem? The problem is that part of the buyer group includes Simon Property Group and Brookfield. Those are 2 huge mall operators and the largest creditors of Express Inc. So they're buying these guys out of bankruptcy. And, Rob, I'm assuming you're going to ask me the question, what could go wrong?
That's exactly my question I had with the malls buying up these tenants. I mean, why is this an actually serious business problem for commercial real estate?
Right.
Sure, we have a very wise viewer base. I'm sure they know, but yeah, that was definitely my follow-up question, Gary.
Yeah. All right. So, right. Because I mean, why is this crazy? What could go wrong? All right. Let's talk it through. The US mall space has 2 giant problems. The first one, this has been going on for decades. The United States has far too much retail selling space. I don't have the numbers in front of me, but I've seen these reports for years, for decades. If you look at retail selling space in the United States, number of square feet of retail selling space per citizen, it is a multiple of what you'd see in any other country. We just have a huge amount of that. And the problem is we had massive amounts of mall space and retail space right at the time that e-commerce became a thing. So I'm looking at the chart right now. Andrew put together the chart. Good job, Andrew Brown, our intern. So we had e-commerce in 2010 of about $45 billion. And as of last year, that was just under $300 billion. That's a big number. So people don't want to go to the mall. All right. All of that creates pressure on the retailers that rent rent space in malls. When they're suffering, the landlords for the malls, companies like Brookfield and Simon Property Group, they've got a problem, right? If you are a mall landlord and you have a whole bunch of stores that are going under and going out of business, they're going to stop paying their rent, right? That's the first thing they're going to cut. So they cut their rent and they go out of business. And as a mall operator, you're losing your stores. And so their answer is, well, we can keep them from, from going out of business by buying them. So you're going to buy them out of bankruptcy. And here's where it gets even crazier. This is doubling down on a problem. Where it gets even crazier is, I assure you that neither Simon nor Brookfield are better retail operators than Express, which was going bankrupt. Right. So what is the one thing that Simon and Brookfield could do to make life easier for Express and these other 435 stores? Rob, here's the quiz for you. What could a mall operator do to make life better for a retail store in the mall?
Free rent.
Cut the rent. Right. So buying these guys out of bankruptcy, either you just bought a bankrupt company and you doubled down. Now you own the bankrupt operator and your tenant, right? That you've just doubled down on the problem. Or the way you fix the problem is by cutting the rent, in which case, why didn't you do that before they went through bankruptcy? And what if you cut the rent, what does that do to if you're the mall operator, if you're the landlord, what does that do to your finances? This is one of the craziest things I've ever seen in my life, where your customers are going out of business. So you decide, well, we'll just give them money to keep them in business. That doesn't mean you have a business. That just means you're pretending to have two businesses.
Wow, that's not expecting a comedy show on this week's 5 things, but my goodness, quite the circus over there. Any other points? Any other final points on that one, Gary?
No, we're going out on a high note on that.
Okay, yeah, that sounds good. Thing number 5 to close up this week's show: FTC bans non-compete agreements.
All right. This one is really, really tricky.
Mm.
As of a week ago, non-compete agreements were legal and regularly used. So imagine for a minute that, you're, say, a technology worker, and you get an offer from a technology company and they say, okay, look, we would love to hire you and we're going to pay you a high salary, but the information that we're going to have to provide you in order for you to do your job is sensitive. It's proprietary. We really don't want this information in the hands of competitors because that could cause a huge business problem for us. So here's what we're going to ask you to do. We're going to ask you to sign this piece of paper that says, in exchange for us giving you a signing bonus or paying you or bringing you on, that, if you leave our employ for any reason, you can't work for a competing company for typically 6 months or a year. They can vary in length. And that's a pretty normal, non-crazy thing. The problem is a lot of companies abuse those, and they use these non-compete agreements in a way that makes it impossible for employees to have a career if they leave. And I know, for instance, there was one company, there's one hedge fund in my industry that did something like that. They located themselves in a place where there really wasn't anything else. There were no other hedge funds, and they locked people up. And, they paid them well, but basically if these people didn't like working there and wanted to leave, they couldn't get another job for a year or two. And it basically was a career ender. And so these non-compete agreements can be abusive. And so the FTC has announced a decision to prohibit non-compete clauses. And, there will definitely be legal challenges. Business groups are already lining up to challenge these. This will be tested in the courts, and it's not due to go into effect for another 4 months or so, something like that, give or take a few minutes.
Yeah, it seems like this one just extremely broad stroke, right? So I gotta imagine, I don't know that there's much more to say, right? But probably something that could be tied up longer than another 4 months when it's supposed to go into effect, or how does that kind of play out?
Yeah, so that is part of the issue. The legislation or the rule was written in a very broad sense. Now, in fairness, it's a 600-page bill. I'm not going to tell you I've read it. I haven't. In fact, let me just state unequivocally, I will not be reading this agreement. I'm not a, an employment attorney. I have no need to read those 600 pages. If somebody else wants to do it and comment on it, you're more than welcome. We're happy to have you on to talk about it, but I'm not reading that. To me, I mean, I think there's value in forcing the country to have a conversation on what constitutes fair and non-abusive two-way employment agreements. I think that makes sense. One of the biggest problems that we're going to have with this is, how is the FTC going to handle situations where there are contracts that are already existing? And so, for example, if the FTC, the Federal Trade Commission, if they ban all of these agreements, what happens to the companies that have said, hey, Rob, we hired you, we gave you access to sensitive internal information, we paid you based on all of this, so we've lived up to our part of this and taken the risk of giving you sensitive proprietary information, and now all of a sudden the government invalidates that contract and tells you you could, like, if you're working at Boeing, you can go work for Airbus tomorrow. That, you can see that's a problem when the government just takes it on themselves to validate contracts that two parties have voluntarily engaged. And now somebody could come back later and say, yeah, but the contract isn't fair. All right, maybe so, but that's what the court system is for the government to invalidate an entire class of legal contracts, just saying these contracts no longer apply. That's going to be a problem. And, people entered into these contracts and lived up to them with the assumption that they would mean something. The FTC is being a little broad here. This is definitely going to be challenged in the court system.
Interesting stuff. Gary, thanks so much again for this week's 5 things. Gary, before we do wrap, I actually had a friend of mine ask, not involved in investing at all, thought it would make for a great little bit of content. But they said, for somebody that, doesn't really know the markets, has very limited investing experience, what's just one quick piece of advice you would give for new investors looking to get into the market right now?
Wow, that's a tough question. I think to start to read regularly, but books, I would seek out sources of information different from the mainstream media. I would not watch CNBC. I don't think you're going to find out anything there. By the time it's on there, everyone knows it, and that's not really great analysis. But I can tell you the way I started, which was reading books on investing. And I remember, the first book that I had, I started reading it my freshman year in college, was called How to Buy Stocks. And it really was a description of, like, what is equity? What is a stock? What's a bond? How do these things work? What's convertible security? And you start to get an understanding there. And then, there are some really basic books. The Intelligent Investor by Ben Graham is phenomenal. I don't think those methods so much work anymore. Peter Lynch wrote a great book decades ago called One Up on Wall Street. There also are, like, Train is the last name of the author. He interviewed a whole bunch of money managers, and you can read about how they think about investing, and you start to get these stories. Basically, move away from television, move away from short form articles, start to read books on investing, and that's a great first step. And it can be intimidating for people, but I wouldn't ask people, what are your top 50 books on investing? Go spend hundreds of dollars, have a 500 book stack on your desk, and then never get started because it's intimidating. Start with a book, right? Set a goal to work through it in a week, a month, a quarter, whatever it is for you. And if you do that over a few years, you'll start to gain a great deal of knowledge, and that will start to open up other areas that you want to explore.
Great stuff. Thanks, Gary. Appreciate that. That wraps this week's 5 things. The Stagflation Issue covered a lot of great topics. We'll be sure to get that content distributed on various channels, X, YouTube, LinkedIn, and obviously via email. If you're not already subscribed for a free subscription, head to deepknowledgeinvesting.com. We'd also love if you would consider a premium subscription. Those start at $100 a month. We also have discounts for students. So if you're interested, please reach out to us. And as we mentioned at the top of the show, we have a new research report that's coming out this upcoming Wednesday. Be sure to be on the lookout for that. We're really excited about that. Gary, any closing remarks from you?
Yeah, just that last point. The only thing I'd add is anytime deep knowledge investing starts to cover a new company, we recommend it. I own it personally. The stock that we're going to initiate on Wednesday and have that report out, I own it in my personal account, and subscribers already know about it. And I've been getting emails from them for the past week saying, looking forward to the report, looking forward to the report. So guys, if you're seeing this now, it's coming on Wednesday. And it's, I think, a great money-making opportunity. It's going to take a few years. It's going to be a long-term situation, but I think it's really interesting, and I'm looking forward to covering that with the company.
Awesome. Thanks so much, Gary, for your time. And thanks everyone for listening and viewing wherever you may be. We appreciate your support at Deep Knowledge Investing. Thanks so much, Gary.
All right. Thanks, Rob. And everyone else, thanks for watching. We'll see you next week.